Welcome to this Killick Explains video and the third part of my series on volatility. Now, as a reminder, I'm not saying volatility is a bad thing. It is the price you pay for the sort of long-term returns equity investors have enjoyed and hopefully will enjoy in the future. But you might as well be aware that we're not out of the woods yet, so it's something just to get comfortable with. Now, getting comfortable with something is easier if you understand it. So, with no more ado, the background is what? And you'll have seen this in parts 1 and part 2 of this series already, so I'll go through it fairly quickly here. Basically, earlier this year we saw stock markets drop by huge amounts around the world. They then bounced quickly. But is that it? No. What I'm arguing is that rising volatility is here to stay, and we need to understand why. We're not going to panic about it. We need to understand, I think, what's going on here. So the three forces. In part 1, I talked about the actions of central banks and very accommodative monetary policy. In part 2, I then introduced the rise of passive products. And by the way, these are still being investigated and researched. Some people disagree that the middle one, for example, has been a big factor, but I think it has been. So I want to now deal with the behaviour, the changing behaviour of investors. And if you want more on all of these points, because I'm about to go at my usual Killick Explains speed, nice paper reference at the bottom there to have a sort of good dig around in. Okay, so the behaviour of investors, part 3. Now here, essentially, I'm going to look at three forces, three sub-forces within a force, if you like. So digital apps and forums have created a huge retail interest in stocks and derivatives. Not for the first time in stock market history, but really on a scale we've rarely seen before. All right. Part 2 of my argument, if you like, is that simple products such as ETFs, which used to simply track the S&P 500, the Spider, or the Dow Jones. These have now become anything but simple. In a lot of cases, they're derivative backed. They're complex and they can have a big effect on the market. And then we've got the controversial, debated role of high frequency trading. Some think it dampens volatility. I'm going to argue I think the jury is at least out on that particular argument. Okay. So the rising retail armies, take the left-hand bubble first, if you like. Essentially, a stat coming up to prove my point. So apps such as Robinhood have spurred a massive interest in something we don't do here at all, we don't advise, single stock trading. People chasing the latest, understandably, I suppose, those coronavirus vaccine stock, or the latest tech stock, the next FANG, or even FANG Man, as I've heard some people refer to the group as it widens. As evidence of quite how much of this is going on, 10 million users at the end of 2019 and another 3 million added in Q1 2020. That's of that app, Robinhood, that I mentioned. And they have traded 40 times per dollar as many shares as well-established US broker Charles Schwab, biggest one in the US. All right, and 80 times when it comes to options. So why am I telling you that? What I'm saying is take a massive established house, compare one of these, some people say upstarts, and you can see that the volume of trades going through is enormous. So no doubt about it, huge retail interest in short-term single stock or derivative positions like never before, and that can only lead to big increases in volatility, particularly around certain names in the market. Structured products, argument number 2 in this third video. So there are, hundreds of structured products out there, but let's just look at one type in particular. So there are many examples in both the professional and the retail market, so not everyone can get access to them. But UBS recently announced the closure of 2. So structured products basically are quite complicated. They'll do things like say, we'll give you twice the return of the FTSE 100 if it's positive, or your money back. That sounds a bit complicated. Or we'll give you 3 times the inverse performance of a particular sector or group of stocks. That's the kind of thing I'm talking about here. So just give you an example of what these things can do to the market, if you like. They have to be backed by derivatives, which gives you the clue that these things actually might be a lot more volatile than the tin name suggests. So UBS announced the closure of 2 leveraged, geared for retail investment trust products with an AUM of 1 billion. And what that did, the selling pressure that put on the market, if you like, pushed the index down by 20% in a day. It recovered a little bit to close at slightly less than that fall, but you can see the scope for supposedly, some people would say, safe products to actually create quite a lot of market volatility. And that's just one example. Now, high frequency trading, does that give you high volatility? Snappy little slide there if you like. So can HFT equal HV? Well, first of all, what is high frequency trading? Now, there's a lot more detail in the paper I'll reference at the end, but in essence, what are we dealing with here? It's algorithm-driven automated trading, described by some people as picking up pennies in front of the steamroller that is everyone else in the market. So it's getting in ahead of everybody else, fractionally ahead, and trying to make a very fast turn on the basis of a computer-identified short-term opportunity. All right, fans say, and that's great. What that does is to narrow, if anything, bid-offer spreads and improve liquidity. Now, the jury's still out, and clearly that's not necessarily my view, but there are people who hold that view. The problem is that margin requirements, all right, in order to run these programs can spike suddenly, and you can get index constituent stocks hit unduly hard. Now, people are still working on the evidence for that, if you like, but if you want an example, if you want a paper that makes that argument in a lot more depth and length than I can here, then I've referenced it down the bottom. And you can find that one and it's free to download. So wrapping up, what do we have here? And remember, it's 3 parts, 3 videos, and within this video on the behaviour of investors, I've dealt with 3 separate forces. What does it all add up to? Well, in essence, the result of all 3 factors, that central banks, the rise of passives, and the behaviour of investors, can create a mismatch. And that mismatch is fundamental. It's between the liquidity needed when markets move sharply and the liquidity that's actually available. And it's that fundamentally exacerbates volatility across equity markets. And I don't think it's temporary. I don't think it's something we can just say happened once, won't happen again. I think volatility is baked in now for some time. But as an investor, once you know that, there's no need to panic. There's no need to change tack. Just accept that it is something you pay as a price for the potential long-term returns that equities can deliver. Any questions on any of those videos in the series? editor@killick.com. And if you want to watch videos on some of the things that I've flown over here in more detail, then it's killick.com/learn.